Thanks for tuning in. You're watching Markets Tomorrow, and finally some respite for the bulls. No change in the trend, but the change in the color of the screen. Instead of red, we had a touch of green today.
Yes, we managed to recoup 6,000 on the index, but let's find out what exactly we should be monitoring in terms of individual stocks as well as levels to watch out for on the frontliners. We've got with us joining in is Anup Maheshwari, Head of Equities and Corporate Strategy at BSP BlackRock Investment Managers, and Ashwini Gujral, Fund Manager at ashwinigujral.com. Anup, given that we've seen that the markets have certainly not gotten off to the best of starts in 2014, without getting into reasons as to why we're here, how do you think we should really approach the scenario right now? Do you think it's a good time to put money to work, or should we be staring at some more painful periods for the markets going forward?
Yeah, this is a very awkward time to try and take very acute calls on the market. Clearly, I think the way we're looking at it is the market continues to trade in a bit of a range. I think as time passes, the probability of it breaking upwards outside of the range keeps increasing, just given the fact that the whole macro scenario seems to be repairing itself now. But you will have these sporadic periods where because of liquidity, because of fund flows, redemptions, etc., you have awkward behavior of the market in short periods of time, and it becomes very unpredictable at a time like this to start following those short-term trends. I think the way we'd like to just look at it is there is a range. As the market approaches the lower end of the range, you start investing because it does find it difficult to go below a certain point given reasonable valuations. And finally, the big catalyst that we're looking for the sustainability of the upside of the market is for lower interest rates, and that's something we are expecting hopefully in the second half of the year. So I think the next 3 or 6 months we'll have to navigate. It's going to be volatile. That's the nature of equity markets. But you do want to participate into excessive downturns.
Ashwini, based on today's price action, to your mind, which is one trend which is jumping out?
Well, the trend that is jumping out is that IT is going through getting into a severe correction, and maybe banks can get a respite while IT continues to keep the market weak. Now the clear way to look at this bounce is that how long and how much above 6,000 can we remain. If at the end of say 3 days from now, if you're hanging out around 6,020 odd, then that means the bounce is clearly failing, and once the trend resumes on the downside, you will get downside coming, because 6150 to about 6350, that range held for 2 months, and from there the market came out with good amount of force. So to expect that 150 points later you have bottomed out is probably saying a lot. So I think you need to go much lower before the market does bottom out, and on rallies now even techs become some sort of shorting candidates, or things that you don't tend to buy just because they have come down.
So where do you see a bottom in this market if the CNX IT index continues to behave the way it does and banks remain subdued?
See, 5700 is a good possibility, and that will be clear once we see the strength of the bounce from 5950. If it's not a very strong bounce, then that means that 5700 should come. At 5700, we'll have to see what kind of global situation is there, what kind of movement is there on other global indices. So maybe from 5700 you could have a stronger bounce, a 150 point type of bounce, but finally I don't expect 55, 56 to be taken out. So broadly we are back into that same old range of 55, 61 types, because we went 300 point below 5500, we couldn't sustain. We went 300 points above 61, we couldn't sustain. So the last 1.5 years it's been a 600 point range.
Anup, the linchpin for this market clearly has been IT, and IT along with pharma are two pockets of outperformance. Now with the US economic data clearly telling us that it's going to be a bumpy ride ahead for US economy, and the US economy still could really, bump along the bottom. What is your take on these two sectors?
So the problem is you can't just exit or enter something. I think you could modulate your weights a little bit. The IT sector, clearly has been driven by the fact that the demand environment in the US has been improving. And obviously any change to that will create some degree of pressure as far as the IT sector is concerned. As far as we see, the IT sector valuations it's a bit of a mixed bag, but overall you would argue that valuations are still reasonable. So again, this is a sector that we'd probably look into a correction more than anything else. But it's not, you can't just move in and out entirely. I mean, that's not the way we would anyway in a mutual fund. It's a matter of being overweight or underweight at a certain point in time. And as it goes lower, we'd probably go overweight on the sector.
Ashwini, what you're looking at on the charts for a BHEL, say it delivers another disappointing quarter, how do you expect the stock to react?
See, given that a blue chip has lost, 80% of the value, I don't think it's in any sort of a bull market. This has been a large, pullback rally from levels of 100 to 180. But overall, the trend on BHEL remains down, and I don't think in any circumstances it should now cross levels of 190, 200. And broadly, should remain range bound to this 150, 180 zone. But finally, at some point, I think the downtrend will restart in this stock, and it should get back closer to 100, 120 kind of zones, provided the market also weakens.
Anup, as a fund house, you are overweight on private banks. Now, given what the economy is doing, is it a good strategy to buy into banking at all? I know there is always a relative argument which is in favor of private banks, but if economy is not doing anything, doesn't matter whether you are PSU or private, banking business per se will not do well.
Yeah, no, absolutely right. I think, in fact, private banks seem to be going through a fairly rough patch. Growth is a big challenge, and most people are quite used to very consistent growth from most of the private sector banks. The way we look at private sector banks is they continue to be great long-term stories. I think the market share shift between public sector and private sector will continue over time. This might be a phase where banking as a whole generally struggles, given the fact that you've got credit demand being fairly poor at the moment, and asset quality, the challenges still exist. So I think overall the entire sector is probably under a bit of pressure, whether you're a private bank or a public sector bank. And also there's a fair amount of capital raise that needs to be done, which is also another problem for the sector. So overall we'd be a little underweight the banking sector, but within that mix we'd still prefer private over public.
A sector which didn't manage to see a reversal in trend apart from the IT index was the way the pharma sector panned out. And you do have Ranbaxy, of course, which will be delivering its numbers. We're expecting that the reported profits are going to be at 125 crores versus a net loss of 492 crores. Of course, the US markets will be driving growth, while this time around you can see the company losing market share for some of the key markets. Domestic markets, that is going to continue to remain under pressure, and the net sales are seen higher by 7%, while margins are seen expanding. Ashwini, in the pharma space as a whole, Ranbaxy, one of those steady blue chips, has seen quite a bit of erosion in terms of its market cap as well. What's your view on where you see Ranbaxy headed?
See, it's disappointed so many times that people will move on. Nobody is bothered about Ranbaxy. You should be much more interested in stocks which are making new highs, the new heroes of tomorrow, like Biocon or Aurobindo, etc. See, people move on. Yesterday's blue chips, today's blue chips become yesterday's blue chips. So, once a stock starts underperforming like this, I don't think there is great downside, but I don't think there is great upside also. And I don't think market will give second chances to Ranbaxy now. It has disappointed way too much for anybody to bet on Ranbaxy now.
Anup, where are you treasure hunting in the entire cyclical space?
Yeah, we would. I mean, we've been always looking at them. It's not really paid much dividend for the last few years, but the fact is whenever things do get better, then they will cover up for quite a few years of holding in terms of their price behavior. But the precursor to getting more and more optimistic on cyclical names will have to be interest rate reductions in the system. Just for equities as an asset class, I mean, it's very tough for equities to compete with 9% tax-free bonds. So you do need interest rates in the system to come down for the asset class to look even more attractive, which we think will be the eventual outcome. But cyclicals will be, in that sense, even larger beneficiaries of lower interest rates, and should eventually perform quite well whenever our economy starts picking up. This year as well, our feeling is the economy will be a little sluggish, but we're counting on next year as a stronger year.
With the 2G spectrum auctions on in full gusto, it's been the telecom pact that, of course, has been the biggest beneficiary of the same. In fact, the interest that you've seen, particularly for 900 and 1800 megahertz, has been very robust. Bharti Airtel up a good 3.5%, but it was Idea Cellular that was the clear star today, ending at the day's high of 7.8%. More steam, you think, Ashwini, for some of these telecom names?
See, it appears that Idea probably made some sort of an intermediate bottom, and these stocks are in a mature business. I don't think Idea is going to 300, but broadly this 130, 175 zone should remain in Idea. So anybody who wanted to trade this sort of a range, 20% type of range, I think you can hold now, or rather buy now with a stop around 135. And chances are, in a good market, you may find the stock at 175, 180.
Time to talk about some of the individual stocks that you need to keep on your radar. We start off with what dealing rooms are flagging off. Gargi is here with the list. Gargi.
Well, the first one is SBI, and we are hearing a lot of buy recommendations coming in from dealing rooms. That is mainly on the back of technical trends, which indicate a bullish, pattern that they are seeing in SBI. About, 1500 is a very strong support that we are seeing for SBI, and in fact, few of the dealers saying that about 5 to 6% increase from these levels is not really difficult. It closed at about 15 levels. We are hearing that at least close to 1580 levels is what we can see SBI, provided the Nifty is going to, continue to gain, and probably on the back of that there could be some buying in SBI. Also, we cannot ignore the fact that most of the banks, especially the PSU banks, have taken a big beating in the last 1 month. The other stock is MCX. Again, a buy recommendation on this one, and dealers, giving buy recommendations to the clients on the back of news that there could be a corporate announcement very soon coming in. We know that there is stake sale talks that are going on for the company, and probably we will see something very shortly. We have heard these rumors, come in before, but if you look at the buying that we saw in the last 2-3 trading sessions, the volumes also indicate something of that sort, 2.5% increase that we already saw on MCX today.
Gargi, thanks a lot for that. Anup, this question is coming your way. And Anup, I was just going through your last declared portfolio, and somehow, even though you are a big fan of the great India demographics and the young Indian population, I don't see too many consumer names in your portfolio.
Well, we have some exposure to consumer, but we have shied away from very excessive exposure to that sector for the obvious reasons. I mean, a lot of these stocks have been valued, much above their long-term averages, and typically they do find it difficult to sustain beyond a point. So purely from a valuation standpoint, there's some excellent businesses and companies there which I'm sure will deliver very good long-term value. But we have to look at alternate options from time to time. So we have some exposures, but generally we're underweight the consumer sector amongst the whole defensive category.
Ashwini, have you run us through your top picks for tomorrow? Clearly, IT is on the sell radar.
Well, CESC is a buy with a stop of 435, target of 462. BHEL is a sell with a stop of 162, target of 148, and United Spirits is a sell with a stop of 2530, target of 2450.